Hey guys, good morning. This is Josh back at Franklin Loan Center with James Gross. Today we're going to kick off week one of an 8-week series that we're going to talk about the different pieces of the transaction and the different people and who touches everything. This week we're obviously going to be talking about the lender's piece of the puzzle, and then as we go on next week I'm going to head over to Generations Escrow and see my friend Kate, and then so on and so forth. We're going to go title, we're going to go shake down Amanda Brock, if she'll even do the video with me, because right now she is on the fence. And then we're going to go to termite, home warranty, we're going to hit an appraiser, and then we're going to finish it off with my buddy Grattan, and I'm going to have him talk about ethics and contracts and why they're all important and what to look for. So, morning, James.
Morning.
How you doing today?
Excellent.
All right. So you guys, like I said, I wanted to talk about the whole process when it comes to a lender, what they do. He does this day in, day out, and we deal with a little bit with him, but I want everyone to understand what he does. So James, I want to start with the pre-approval process. I know we've kind of talked about this in the past, but what is the pre-approval process? What are you looking for? What are the credit scores needing to be at? Like, what's the lowest you can go? What does that mean when you go lower? And just talk about like what programs are available when it comes to that.
So there's two types of approvals. There's a pre-approval and a pre-qualification. A pre-qualification is where the lender runs someone's credit report and then just verbally accepts what they tell them that their income and assets are, and then they issue a pre-qualification. In today's real estate world, I know a lot of agents don't accept those. And then a pre-approval technically is where you're verifying 6 main items. The client does the credit report through the lender collects the client's income and assets, which that means, depending on their employment, could be as simple as a pay stub and a W-2, all the way down to a pay stub, W-2, tax returns, and corporate tax returns if they're self-employed. In addition, they'll collect traditionally 2 months bank statements, or asset statements is what I like to say, depending on where the funds are coming from. And then they review everything, they enter it into the computer system, which is known as the origination system, and then they run the AUS, the automated underwriting system. You as agents out there know that as DU, desktop underwriter, or LP, loan prospector, also known as Fannie Mae and Freddie Mac underwriting guidelines.
Okay, so you mentioned something real quick that kind of caught me. I hear agents all the time asking for the DU, the desktop under. You know, we've had talks to you and I in the past about this. Can we elaborate to other agents kind of what that is and what value it really even holds? So
I do a lot of cross approvals, 5 to 7 a day, and a lot of the loan officers want to just send me the DU. A DU is only as good as the paper is on. So
right. Okay.
You as a loan officer, someone, say it's really a pre-qualification you did, you run the person's credit, and then the client says, yeah, I work at Home Depot or Lowe's and I make $60,000 a year, so the loan officer puts $5,000 a month for income, doesn't really get a history of how long they've been there, automatically puts SFR as the type of property. So the client says, yeah, I've got $18,000 in my savings account, so the loan officer puts $18,000 in the savings account. In the system, they run, which you know as DU. I call it AUS because I might run the Freddie Mac version.
Okay.
And then it gives us findings on what it accepts, if it's acceptable or not. And then the loan officer gives that to their agent, and the agent sends it off with the pre-approval letter. Okay. Now here's the dilemma with that. What happens when the client turns around and finally sends the pay stub and the W-2s, and the client really works an average of 32, sometimes 36, sometimes 31 hours, it varies. So really their W-2 said they made $48,000 in 17 and 36 in 16, and then year to date looks like they're going to make 55. So technically the underwriter will average the income. So now it takes the income from $5,000 a month to $400 a month. Well, now your debt to income ratio could have completely changed and you don't qualify. Or they gave that DU and the client on a single family resident, and then the client is looking for a property with a little more land. They can't afford a stick built home, so they pick a manufactured home.
Gotcha. Okay.
Well, the DU, also known as the AUS, is going to come up with a different finding based off the type of property, because a manufactured home is considered a higher risk than an SFR and a condo.
Okay.
So your DU really is, in my eyes, is no good until the underwriter has reviewed, accepted it based off of the findings of the income and assets,
Okay.
the correct income and assets.
Gotcha. So
really, if when you agents out there are asking for DU, it's only as valid as the person entering the information, and if they didn't verify the information or do it correctly, it's no good.
okay. So do you? Yeah, maybe. Anyway, so we'll get back to what kind of credit do you need to have to get approved?
So that varies on the depending of the loan. So
Okay.
conventional lending, which is your conforming 453,100 in our county, if you're in Riverside, is a traditional known as a Fannie Mae or Freddie Mac loan. They will not allow below a 620 credit score. No ifs, ands, or buts. It's their guidelines, not a lender's. But just because you have a 620 or a 625 does not mean it's going to approve you because it looks at different risk factors. You know, if you might have a 623, but you might have 7 items on your credit report in dispute, so the AUS DU is not reading it properly, so in reality you can get a decline.
Okay.
So that's conventional. Then you have government, which is VA and FHA, and I guess you would call USDA. They have different credit criteria. Technically, FHA will go down to 500, which a lot of people don't know that.
That's crazy.
Most lenders don't go below 580. We will go below 580, but you have to get the AUS approval. When you go below 580, it's a 10% down loan versus a 3.5% down loan.
Okay.
And that's an FHA guideline. VA actually doesn't have a credit score criteria. VA does risk-based underwriting. So there's based off residual income. There's different factors it looks at. Again, some lenders don't go below 580. We will, but it just depends on the risk and if I can get an AUS approval.
Gotcha. Okay. I didn't know that. I thought there was credit involved with VA.
Yeah.
What kind of down payment programs? I heard the 3.5% down, 10% down. What are some of the programs when it comes to down payment assistance, stuff like that?
Sure.
They can.
So you have your traditional financing, which is your, FHA 3.5%. Conventional is, traditionally as little as 3% down. Jumbo can go as little as 5%. Although conventional lending has rolled out a program which is 100% financing conventional loan.
That's gnarly.
It does have debt to income ratio restrictions. It has credit criteria restrictions. It's very hard to get what's called the AUS approval on it.
Okay.
But I have done a few. FHA is a 3.5% down loan. There are lenders saying there is a zero down, 100% financing FHA. It's because there's a grant behind it or a down payment assistance program behind it.
Gotcha.
So there are ways to get to 100%, but FHA is a 3.5% down loan.
Okay.
Down payment assistance programs are stuff like Chenoa, which is behind an FHA, which will allow you to go to 100%. There's CalHFA in California, which allows you to go to 100% as well as pay all your closing costs. There's another Golden State or GSFA. There's different names for it. That one will allow you to go to 100%. There's the county programs, Riverside County or the city of Riverside, which will give you funds for your down payment, which will allow you to go to 100% as well. Those are a little.
So there's tons of them.
There's so many of them. The county programs do take a little longer to do because of the time periods for the county and the city.
Okay.
Versus doing the CalHFAs or the grants through GSFA and so forth.
Okay. Awesome. Okay, so let's say you get approved and you go out shopping and you find a house and you make an offer and it's accepted. So obviously I make contact with you and let you know that their offer got accepted. What should they be expecting now from you?
So when I do the pre-approvals, I try to ask for everything up front. So when it comes to the time of their offer being accepted, there's very little stuff they have to get to me.
Okay.
So traditionally with my clients, once you have an accepted offer, I will ask for maybe an updated pay stub, an updated bank statement, because my stuff might be 3 weeks old or a month old or 2 months old, just depending on when we pre-approved them. We'll send them a copy of their credit report. Within that credit report, there's some disclosures they have to sign of explanations of AKAs, or prior credit inquiries. We need to make sure they're not trying to get 2 mortgages at one time, or if there's a credit report. A lot of times on the credit report, a client just gets a brand new credit card, but it's not on the credit report yet, although the credit inquiry will be on there. And that's where a lot of lenders miss that. So then we say, hey, what was this Chase credit pull 2 weeks ago? And they'll say, well, I applied for a credit card. Well, did you get a credit card? And that's how we kind of find out.
Gotcha. Okay.
We will ask if it's a gift they're getting for the down payment. At that point, we'll send the gift letter, because now we can put the address on the gift letter, that we have an address. And that's pretty much all we need from the client. Normally, our clients aren't really getting us much after. By the time their offer's getting accepted, it might be 3 to 4 items.
Okay. And you guys, just one thing about the gift letter is it's anytime that money moves into your account, they need to know where it's coming from. And that's going to get to our next question, which we're going to start talking about the underwriting. You'll hear your loans being submitted to underwriting. So most people don't understand what that means. So what does that mean, and where does it go, and what really happens?
Okay, so an underwriter's purpose is to verify that the collateral, which is the appraisal, is done properly, the adjustments on it, the comps, and so forth. They're also going to verify the income, so to make sure that the loan officer put the income properly in there. They're going to get a verification of employment, make sure there's no funny things going on between pay stubs and verification of employments or tax returns.
Gotcha.
And so forth. They're going to verify the assets, that there are no funky movement like you were talking about. Client has $3,000, beginning balance, ending balance $60,000. Well, where'd those funds come from?
I'll take it any day.
Yeah. So a lot of times when we have clients that are getting gifts, we say, hey, don't have the family member, whomever's giving it to you, give it directly to you. We want that member to send it directly to the escrow company via wire.
Right. Okay.
Because if you do it through a wire, then the only thing we're doing is a gift letter. If they give you the money, we need to get a copy of their bank statement. We need to see the movement of the money on where it really came from.
Well, you can't move free cash?
Nope.
Oh, man.
Those days are gone. 2006 is gone.
Oh, okay.
So that's what the underwriter's purpose is, to verify all those things are accurate. And once those things, they have verified how accurate it really is, they'll give you what's called a conditional approval.
Okay.
At conditional approval point, sometimes it might come back with an item or two that they say, hey, you know what, you need an updated pay stub. This one's about to expire by the time we close. Because none of the documentation can be older than 30 days from the time of close.
Okay, gotcha.
Or they need something from an escrow company, or maybe one of the realtors missed a signature or something like that. So we'll reach out to the agents and for something that might be missed. Just basically fine-tuning the file to get it ready to be insured through Fannie or Freddie or whomever's doing the loan, securing the loan.
Okay. Awesome. So let's just say everything clears through underwriting and it goes back to you. What happens then?
So once we're cleared through underwriting, at that point, we're going to request loan documents.
Okay.
Let me step back though. So one of the things that's important when your lenders are getting these loans approved, they need to request the closing disclosure right away. So once you get that appraisal in and your final costs from escrow, and you fine tune everything, you need to make sure that CD gets out, because there is that 3-day waiting period before you can sign on the 4th day.
Right. That's one thing that people forget sometimes, is that basically the 3-day has to happen regardless. Then that came out of all the
TRID.
Yeah, basically, yeah.
Yeah. So one thing that we do, so when it's coming out of our final underwrite, we're getting docs to escrow within 24 hours. 99% of escrow companies want you to use their notaries because it's who's approved through their title company and so forth.
There we go. We're back.
They get emailed to escrow. Escrow arranges the signing. Escrow traditionally scans loan docs back to us, gives us time to review it, make sure there's nothing missed. And then we get the loan docs back the next day, and we're ready to rock and roll and fund and close.
Awesome. All right. So you guys, just to recap real quick, so we have multiple layers within that, but it's pre-approval, offer accepted, clean things up, get into underwriting, get out of the underwriting, and get it funded and move into your new house. So if you guys have more questions about the loan process, feel free to reach out to James at Franklin. He'll be more than happy to explain more of this stuff in detail. And if you're looking to buy and sell, let me know. This is Josh with the Anchored Realty Group, hanging out with my buddy James from Franklin. You guys have a great day. Love you all. See you soon.